Welcome to the deep dive. If you need a shortcut to understanding where the real money is flowing in the current technology boom, well, this is for you.
And we have a really big one to get into today.
We absolutely do. We're dissecting the Q1 fiscal year 2026 performance results. They were released just yesterday.
Yeah, we've got the official conference call transcripts, the press release,
Yeah.
the whole sack.
The whole stack.
Yeah.
And our mission here is to quickly extract the core narrative. So forget the spreadsheet totals for just a moment.
Right.
We want to see what technologies are actually driving this surge.
And what we found is that it's not just one thing. It's really two powerful intertwined tech cycles that are hitting maximum speed at the exact same time.
Exactly.
This deep dive is so critical because it moves that whole AI conversation from, the theoretical to something entirely measurable.
Tangible.
Yes. For you, the listener, this report shows a very real shift in network architecture that's just driven by pure necessity.
You have the massive AI infrastructure build-out demanding speed on one side.
And then you have an old enterprise networking base that's finally collapsing under the weight of all these new demands. Both are generating immense revenue right now.
Okay, so let's start with the financials. They crushed expectations.
Right, really did.
The headline numbers. Q1 revenue hit $14.9 billion. That's an 8% increase year over year.
And the profit measure, the non-GAAP EPS, landed at $1.
A 10% year over year jump. Strong numbers all around.
The totals are great, but the most interesting thing here isn't the total revenue, it's the composition.
The mix.
Yeah, you have to look at where the growth is and maybe more importantly where it isn't.
Okay.
Product revenue drove the entire show. It was up a significant 10% year over year.
While services revenue barely moved, what was it, up just 2%?
Just 2%.
And when we drill down into those product categories, the picture becomes crystal clear. Networking revenue just exploded, up 15% year over year.
A huge jump.
Observability also showed some decent growth, up 6%.
But, and this is the important part, security was down 2% and collaboration dropped 3%.
That gap feels like a huge strategic signal, doesn't it?
It absolutely is. It tells us that customers are prioritizing the immediate infrastructure needs.
The pipe.
Exactly, the secure pipe that carries the data over, adjacent things like conferencing tools or standard security platforms.
When you see networking surging 15% while those other segments are actually declining.
It just underscores that the market sees them as the primary provider for high-performance, secure, physical networking. That's job one.
And because of that strength, they're feeling pretty bullish. They've raised their full-year FY26 guidance.
Yeah, they did.
We're now looking at revenue expected between $60.2 billion and $61.0 billion.
Which is a definite marker of confidence that this demand is sustainable through the whole year.
Okay, so this brings us to that first cycle, AI.
Right.
And here is the number that everyone is talking about. $1.3 billion in AI infrastructure orders taken in Q1.
Just from the hyperscale customers.
Just from them. That is colossal.
Yeah.
And it marks the 5th consecutive quarter of robust order growth with those massive cloud providers.
$1.3 billion is staggering. It really shows the AI build-out is moving faster than even the most aggressive analysts had assumed.
And if you connect those orders to their annual expectations,
they're forecasting $3 billion plus in AI infrastructure revenues for the full fiscal year 2026.
Okay, wait a minute. That's a perceptive quotient. If they hit $1.3 billion in Q1 alone, why are they only forecasting just over double that for the entire year?
Right, why just over $3 billion?
It sounds surprisingly conservative for Q2 through Q4. Is management signaling some kind of significant slowdown?
That's the key question, isn't it? I mean, we have to assume some level of conservatism in there.
Sure.
But the sources also indicate it's partly due to delivery phasing. The orders right now are balanced between the physical systems and the advanced optics.
So that $1.3 billion mix included a lot of high-speed connectivity solutions.
It did. And let's focus on those optics, because connectivity is the silent hero of AI scale.
So what exactly drove those strong Acacia optics results?
It comes down to a really important technical shift, the transition to coherent pluggables.
Okay, explain that for our listener.
Well, think of it this way. AI data centers need these vast rivers of light to move data around. Pluggables are these tiny, high-speed optical transceivers. They're miniaturized, powerful systems that deliver massive cost and power savings compared to older tech.
And they just slide right into the standard gear.
Exactly. For a hyperscaler managing tens of thousands of racks, minimizing power consumption and cost per bit, that is the single biggest factor. Pluggables solve that headache.
That makes perfect sense. And while the hyperscalers are grabbing all the headlines, the broader market is also starting to warm up.
It is.
We saw over $200 million in AI orders in Q1 from neocloud, sovereign, and enterprise customers.
And the pipeline signal is even bigger. They see AI opportunities exceeding $2 billion for those non-hyperscale customers in FY26.
So this is just starting.
And the foundation making all this scale possible is their proprietary hardware, Silicon One.
Right. They unveiled the P200 chip in Q1.
Specifically for what they call AI scale across networking. The new 8K router, which is powered by that P200, offers truly unmatched power efficiency and scalability.
And their internal goal is pretty ambitious.
Very. Comprehensive adoption of the Silicon One architecture for all high-performance networking systems by fiscal year 2029. And they expect to ship the 1 millionth Silicon One chip by Q2.
Wow.
That is the hardware commitment that's underpinning this entire growth forecast.
Okay, so that's the massive data center investment story. Now let's pivot to the second major growth driver.
The one happening right inside corporate and university offices.
Exactly. The major multi-year, multi-billion-dollar campus networking refresh cycle.
And this is a classic case of necessity forcing action. We saw networking product orders grow in the high teens overall.
The fifth consecutive quarter of double-digit growth.
Right. And this isn't just routine replacement. Customers are actively bolstering their enterprise networks in anticipation of AI workloads hitting their offices.
You can't run this new stuff on old gear.
No way. Trying to run sophisticated AI agents on 10-year-old infrastructure is like trying to stream 4K video on dial-up. It just doesn't work.
So why the urgency right now? We heard a lot in the call about the pre-Cat 9K installed base. Explain why that term matters.
It's a bit niche, but it's really important. Pre-Cat 9K refers to switches and hardware that are rapidly approaching their end-of-support lifecycle.
Got it.
This installed base represents tens of billions of dollars worth of equipment. When hardware hits end of life, IT departments are forced to upgrade.
For security, for compliance reasons.
Exactly. And the key insight is that they aren't just replacing old gear with the same capability. They are jumping straight to next-gen platforms designed for the speed of AI.
And the market is validating this. The sources highlight that all their new solutions, the smart switches, secure routers, and the new Wi-Fi 7 products,
All of them.
they're all ramping faster than any of their prior product launches.
People are not window shopping. They are buying immediately.
Right.
And we saw accelerated order growth across switching, routing, wireless, and IoT. It all points to this unified rush to a secure, faster, more robust campus architecture.
The enterprise gets it. The bottleneck for AI performance isn't just the data center.
It's the network connecting the user to the data center.
This leads us to a crucial, future-facing concept that's driving all these upgrades: agentic AI. This is the move beyond simple chatbots to fully deployed AI agents that are working continuously across applications.
In interacting with end users constantly, this changes the entire demand model for networking.
How so?
Well, standard chatbot models, they cause occasional noticeable spikes in traffic. Agentic AI is expected to keep network traffic consistently high.
Always on.
Always on, always working, always processing and interacting. The traffic levels won't just exceed current levels, they're going to stay permanently elevated.
And if the traffic is always high and always critical, the mandate for security changes instantly.
It has to.
Security can no longer be bolted on as an afterthought. It has to be deeply embedded into the network fabric itself.
And that's why there are new offerings, like the Cisco Data Fabric using Splunk and the Cisco Unified Edge for real-time inferencing.
They're vital for this next phase.
Exactly. Now, if you look at the financials that support this multi-year confidence, the stability metrics are extremely strong.
The RPO, remaining performance obligations.
Right. That's the revenue they expect to recognize from existing contracts. Total RPO hit $42.9 billion, up 7% year over year.
And product RPO was even stronger, up 10%.
It's the ultimate predictability metric. It shows you the long-term commitment.
And the annualized recurring revenue, or ARR, is solid too. It reached $31.4 billion, up 5% year over year.
These metrics aren't just numbers. They signal that customers are committing to subscription-based services attached to all this new hardware, which cements that future stability.
And finally, a signal of executive confidence. They returned $3.6 billion to shareholders in Q1.
Which was 125% of their free cash flow.
That included $2.0 billion in share repurchases and $1.6 billion in dividends.
The fact that management is returning more cash than they generated shows they are incredibly comfortable with the future cash flow from these AI and campus pipelines.
They don't feel the need to hoard capital.
Not at all.
So, to summarize this entire deep dive, the Q1 results confirm that the infrastructure demands of AI are driving massive, measurable order acceleration.
Not just in the data center, but across the entire corporate network landscape.
The dual forces of the AI build-out and that urgent campus refresh are completely intertwined.
And they're fueling today's growth and setting the stage for future revenue predictability.
Right.
So we've covered the shift from, occasional chatbot spikes to the continuous constant demand created by agentic AI. This is a fundamental change in how networks are used.
It changes everything.
It does. So the question for you, the listener, is this. If AI agents keep network traffic consistently high and constantly critical, what previously assumed limitations on network capacity?
Things like security and power management.
Exactly. What limitations on those things must be urgently reassessed across every industry, not just in technology?
That's the strategic headache they've just signaled to the entire market.